Bond mutual funds. Advisors that specialize in income-producing instruments, as compared to the stock market and growth-oriented instruments, tend to specialize in individual bonds and bond-like instruments instead of bond mutual funds. This is because when an investor buys an individual bond, they have two important guarantees. First, they're guaranteed a fixed rate for the life of the bond, and when the bond matures, they get their principal back, assuming there have been no defaults. With that assumption, an investor knows exactly what they're going to earn on the bond that they hold to maturity. So how then do bond mutual funds compare to individual bonds? Bond mutual funds don't pay a fixed rate of interest. As a matter of fact, the interest that they pay fluctuates. Also, bond mutual funds don't have a maturity date. They will go on forever or until you liquidate them. So both guarantees that are inherent in individual bonds are off the table, so to speak, with bond mutual funds. So why does this matter in the real world? Most investors know about the inverse relationship between interest rates and bond values. When interest rates go down, bond values tend to go up. And when interest rates go up, bond values tend to go down. If something happens in the bond market to cause bond values to drop, a portfolio of individual bonds, as well as bond mutual funds, might drop the same in value. However, if you're holding individual bonds, the loss is simply a paper loss, because you're going to still receive your fixed interest payment. And when the bond matures, you're still going to get your principal back, assuming there are no defaults. But if you're holding bond mutual funds, you may never get all of your principal back, as bond mutual funds never mature. There's one reason bond mutual funds can be a lot riskier than individual bonds. In addition, bond mutual funds have management fees associated with them, which effectively lowers the yield. These fees do not exist with individual bonds. With individual bonds, there are only fees when you purchase or sell a bond. Why then do financial advisors utilize bond mutual funds instead of individual bonds? It may be because most financial advisors today still specialize in growth-oriented, stock market-based strategies, and because the analysis of stocks and stock mutual funds is much different from the analysis of fixed income investments, they typically take the easy way out and put their clients into bond mutual funds. So, in a way, you can think of bond mutual funds as a simpler way for stock market-based advisors because they're leaning on a fund manager to pick the individual bonds for them. But like most things in life, simplicity comes at a cost. There is, however, a time and place for investing in bond mutual funds. For instance, if you were an investor just starting out and you didn't have enough capital to properly diversify in a portfolio of individual bonds, then at least bond mutual funds give you a way to leverage a low dollar amount to help you diversify your portfolio. However, most people in or near retirement who have saved their hard-earned money over a longer period of time are better suited to invest in a portfolio of individual fixed income securities for the purposes of reliable and steady income.